You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit TheOptionsInsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. Well, we talked a little bit about the volatile times recently and how volatility has started to come off, but is still very high. And that's going to be the theme of the strategy that we're going to look at today. Today, we're going to look at a long call spread. We're going to put a little bit of a twist into this, but it's going to be a long call spread in the S&P 500 index, the good old SPX. But before we go there, I want to talk a little bit about the skip strike butterflies. We did a couple of these in Google recently, and I'm going to point out exactly what happened with Google and the trade from last week. So if I go back and we go back in time to the 13th of May, we were looking at Google. The market had closed. The stock was at 1348. We looked at what the potential expected move was, and we talked about the fact that volatilities were still a little bit high, but they weren't outrageously high. But everything has came off. Even though we've had earnings, they've all came off as far as volatility is concerned compared to the times when we had the big drop down in the marketplace because of the coronavirus fears. So with that said, volatility is still a little bit higher. And so I like strategies like something that doesn't mind a volatility crunch, like a butterfly. And specifically last week, we talked about a skip strike butterfly in Google. And we said, well, all of the FANG stocks have announced earnings recently, but with Google, they have the volatility still stayed pretty elevated across the board. So what did we do? We looked at doing a skip strike butterfly in Google. And for the record, I do own some Google in my account, just for the record. But nothing's meant to be a recommendation here. We're only trying to learn, and we're looking specifically at the general conditions of the marketplace and what strategy might fit these general conditions or these turbulent times. So when the VIX was up around 80, it was hard to think about anything as far as just buying stocks, buying options, doing whatever in the marketplace, because the VIX is so high, you're trading volatility just as much as you are trading the option contracts when you think about it. And also there's true volatility in the marketplace. As a matter of fact, the historical volatility at that time was actually higher than the implied volatility on a 30-day basis when we had the big downturn. So overall, we've came back down now on volatility, and I'm just going to focus on the VIX. So we had the VIX come back down to 40, and it stayed at that 40, 50 level. Once it got below 50, 50 seems to be kind of a magic number in the VIX index, in that once we get above 50, it's like no holds bars. Like, where would it stop next? But 50, if we look back, going all the way back to the 2008 crisis, there's only been about 4 times where we've actually even came close to hitting 50, and we obviously breached it just recently with the recent scare of the coronavirus. So now we see the VIX. Today we are taping Options Playbook Radio on the 20th of May. It is 4:30 Eastern time. So the markets are closed right now, and we have the VIX index closing at almost exactly 28, and we have the S&P 500 index at this point in time that closed at 2,971.61. A pretty good day today in the market. It was up 48.67 points in the S&P 500 index. And in Google, over the week, we had a fairly decent run-up. So when we looked at the close on the 13th, Google closed at 1348.33. And I find this to be an interesting trade in that the stock basically did what we would like it to do. The market did close at that level, and then the very next day, it actually opened down. Google with an L, Google, or Alphabet, if you will, opened at $1,333.52. So it opened down a little bit. And if you're doing skip strike butterflies, that's kind of a good thing, because when we're doing it, we ideally want the market to come up within the width of our strikes. And the strikes that we did in the skip strike butterfly in Google were, we bought the 1375, sold 2 of the 1385s, and bought the 1405s. So the fact that it goes down a little bit kind of helps you feel better about not losing the maximum on the trade, because your biggest risk is if Google actually runs up quickly and it went up to 1395. That's where our risk kind of kicks in based off of those strikes. And so if we get a little bit of a movement down, well, that's a good thing overall. And then we want the markets to start going back up. We had a very short trade. It was going to close on the 15th. And what ended up happening, if you see the stock, the very next day it moved up a little bit. That opening was back where the original trade was at, 1348. And then the market actually closed on that day at 1373. Okay, so that was the close, which was very close to the high. The high was 1374. Guess what we needed Google to do? We needed to get above 1375. But if you think about it, so there was a point in time where you could have made some money on the trade that it sold. You put it on for net credit. I think the net credit was around 15, 20 cents. I can't remember exactly, but I think let's call it 20 cents. And the fact that it finished below 1375 just means that you're going to get that net credit. So if you stuck your head in the sand and you didn't watch this trade whatsoever, you would have made at least that 20 cents. There would have been many opportunities as the underlying was approaching the 1375 mark to sell it and close it for a net credit for a little bit higher. But if you didn't take advantage of it, you still made that 20 cents. The ideal situation obviously would have been if we would have finished at 1385 at our short strike, we would have been 10 points in the money on the 1375s. But this is the ideal scenario, and this is why I would prefer to do these trades in elevated times of volatility, but that elevation isn't caused from an earnings report or something major that's going to be announced in that underlying stock. We just have a fairly volatile market that has came down a lot as far as implied volatility is concerned. And a skip strike butterfly in medium volatility is a really good trade to think about. I don't care what your underlying is, and I don't care your direction. You could do this the exact opposite way now in Google if you wanted to. Turn around and do a skip strike butterfly on the downside using puts. So that's just what I want. That's, I guess, as Forrest Gump said, which was on the tube recently, that's all I have to say about that. Okay, let's move on. Next, we're going to keep the same theme. The volatilities are elevated, but they're not skyrocketed. So we're going to look at the S&P 500 index. And when we see the volatility in the S&P 500 index, which the VIX tracks, up over 20%, I prefer to do a trade that's called a long call spread. So the SPX has many different expirations to choose from, and I talked about this on the Tuesday midday market call on the Ally Invest WebEx platform. We actually had a little bit of a discussion there, but I'm going to go back and I'm going to do a rinse repeat here, and I'm going to talk about buying a long call spread in the SPX, and we are going to place that trade with only 2 days remaining. And the whole goal here is that we're going to sell more time than we are buying. Hence, we are doing a debit spread, but we are actually net positive time premium. Okay, so here's the trade, and then I'll discuss it, and then I'm going to give you an alternative. And I've talked about this before in Options Playbook Radio, but once again, as we go through the years, there's times when the trade works better than other times. And I'm not just saying that it works better and that you were correct on your forecast. I'm saying that when we have the VIX at 28, this is a more interesting time to look at a strategy like I'm going to propose today. Not meant to be a recommendation. Everything's a paper trade, so we just need to learn here on Options Playbook Radio. All right, so the index closed at 2,971.61. We want to sell the most at-the-money option contract, which is the 2,970 strike call. That's going to be the call that we sell today. And we are going to go down 5 points, and we are going to buy the 2,965 strike call. Why do we want to do this trade? Because of the VIX, the volatility is still up over 20%. As a matter of fact, in this 2-day option contract, it's at exactly 24% based off of the Ally Invest option chains. And we see that the bid-ask price is $22.20 by $22.90. Now, granted, the markets are closed, or 70 cents isn't bad, but there's still $22 worth of time value on this $1.60 in the money option contract, and there's only 2 days remaining in the life of that contract. You have all day Thursday and all day Friday for that option contract to live. Okay. Now, these are the weekly option contracts, so they do trade all day on Friday. So you got to be aware. In the SPX, there are some weird rules, and you always got to make sure in this cash-settled index, you know exactly which option contract that you're trading. Okay. Then this is a PM-settled contract, which means it trades all day on Friday. Okay. And it's based off the settlement's based off of the close. With that said, if I do this trade, I am 5 points wide. And I am $1, I'm $1.61 in the money on the option contract that we're selling. If the market just stays where it's at, it's a 5 point wide spread. The total cost at the midpoint of this trade is $2.90. For every 1-by-1 spread that you would do, that means it would cost you $290 plus commission to get into that trade. It is a debit spread, which means that debit is our total risk. $290 would be the total risk. Now, granted, we are already in the money on this trade. If the stock just stays where it's at or drifts higher, we're okay. We just needed to not close below 29.70 in this instance. The upside here, 5 points wide minus 290, that is the upside would be $2.10. So I have a trade that I'm putting on. If the market stays where it's at or goes higher, I am risking $2.90. I could potentially make $2.10 overall. And if the market stays where it's at or drifts higher over the next 2 days, this trade would be profitable. All right. Now, if I open up tomorrow and the market's down, let's say it's down 10 points on the open. Here's the little trick that I'd like to propose. I am long this call spread. I have a lot of premium in this option contract. If you're doing a butterfly, all it is a combination of a long spread and of a short spread. The difference here, the thing with a butterfly is the option contracts that you're selling for each spread are the same option contracts, right? So in this instance, we're selling the 2970 strike. So if we made this a butterfly, we would go out and sell another one of the 2970 strikes and buy one of the 2975s. So I build this trade as I don't want the cheese anymore, but just get me out of the trap. So if the market opened down tomorrow, which is very possible, and I had this position on, one thing that you might do is actually roll it into a butterfly. And I think this makes a great paper trade, a great learning experience. And I'm going to do it based off of the net credit that I could receive from rolling it into a butterfly. So right now, with the markets closed, they're not moving, so that kind of helps us a little bit. We could actually sell the spread. That would be our hedge in this position. I guess our hedge, I guess adjustment would be a better word, which would be our adjustment. We could sell the 2,970 strike call and buy the 2,975 strike call, completing our butterfly for a net credit of $2.65 on the midpoint. That means that the butterfly, if the debit spread is trading for 290 and the credit spread is trading at the midpoint of 265, this entire butterfly could be done for a net credit of 25 cents. Net debit, of 25 cents. Net debit or $25 plus commission. Now you might say, well, why don't I just do the butterfly to start? Well, you can, but you got a 10-point range that the stock's got to fall in. That's pretty tough in this with the VIX at 28%. It would have to stay between 29.75 and 29.65. So I don't think a 5-point wide butterfly in the SPX really makes a lot of sense centered around an at-the-money price. But if I'm doing it as a hedge, I kind of like it a little bit more. So here's the way I would approach it. I'm going to pay $2.90 for that long call spread. If the market goes down, I'm going to guess around 10 points or so, and the net credit for the short spread, the adjustment spread, starts trading for, I'm going to say, $1.50 net credit to the account. That means the market's gone against you. But I can now sell that credit spread instead of just closing out of my trade and trying to salvage what's left of my long call spread and being done with this trade. I'm going to sell this credit spread, bring in a net credit to the account, and I'm going to reduce the risk of my long spread and still give myself a chance if the market bounces back. Right? So if I can bring in $1.50, I bought the debit spread for $2.90. I bring in a net credit of $1.50. Now my total risk then would be $1.40. And I got a chance, right? So the market's now down way below my middle strike of 270. I'm going to say 10, 15 points down. Now, you got to make the adjustment fairly quick. You can't wait till it goes down 50 points. There's going to be nothing to sell. So I look at the credit spread. I sell that credit spread, bring in $1.50. So that's what I'm focused on is how much credit I can receive. So I know that I'm reducing the risk by an amount that's acceptable to me. And then if the market comes back, this butterfly could trade for as much as $5 if it closed right at the middle strike. But let's say it trades for $1 or $2. Maybe I make a dollar. Maybe I only lose 50 cents. Maybe I make $2, right? There's a potential now, and then I can just let it ride all the way to expiration if I'd like. Obviously, I could close it at any time, but now I've already adjusted. I've already reduced my risk, and now I'm just going to let it ride. All right, so let's recap. I'm getting a little bit long-winded here. So because the S&P 500 index in the VIX is trading at 28, an acceptable volatility. It's not 50, it's not 40, it's 28. It's created enough volatility that we still have a lot of juice, even with only 2 full days of trading left on the S&P most at-the-money option contract. That's trading for $22.50 approximately at the midpoint. So we're going to sell that option contract. Then we're going to go 5 points down, and we're going to buy the 29.65 option contract. So we have a 29.65, 29.70 long call spread that expires May 22nd, 2 full days of trading before that expires. We pay $290 for a 1-by-1 spread plus commissions, or $2.90 times 100, or $290. We hope the market goes up. Market just goes up 5 points or so. We could probably get out of this trade at a decent dollar amount, right? Just all we need is one good day of time decay. Market goes down. Oh no, we got an issue. What do? Do we sell? Do we get out of the trade? No, we're going to roll it into a butterfly. So then we sell a credit spread. Why? Because we're going to take off the risk of our long spread, of our debit spread. And how do we determine when we're going to sell it? Well, when the credit's at a point where I'm okay with enough credit, but I've reduced my risk enough on the long call spread to let the trade ride. So I do that. I'm going to say we get it done for $1.50. Now we have $1.40 of risk, and we have a 5-point wide butterfly, which the maximum of that butterfly would be $5. And we hope that the stock finishes between $29.65 and $29.75 at that Friday expiration. That's it for Options Playbook Radio. If you have a question you'd like to ask me, please send them directly to me at TheOptionsGuy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out. Be safe out there.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.